All right, let's talk about one of the most common frustrations for investors. You want that sweet, sweet income from your portfolio, but you absolutely hate the thought of missing out when the market just decides to take off like a rocket. So, is there a way to get that income without giving up all that growth potential? Well, let's dig in.
So, I've got a question for you, right off the bat. Are you a covered call bear? Now, I know it's probably not a term you hear every day, but stick with me. It describes a very specific kind of investor, someone who's a little bit wary of the old school income strategies. Let's see if this sounds familiar. So, a covered call bear is someone who sees the appeal of income from strategies like covered calls, where you get paid a premium for selling someone else the right to buy your stock. But you're worried. You're worried that in a big rally, that strategy is just going to cap your gains and leave you in the dust. You're not totally against it, you're just skeptical of the rigid, one-size-fits-all approaches. In that skepticism, that feeling right there, it brings us straight to the heart of this whole thing, that constant tug of war between getting income today and capturing growth for tomorrow. Here it is, the classic trade-off laid bare. Yeah, on the one hand, you get that income generation. You get a little bit of a cushion when things get choppy. That's great. But on the other side, you see that big one, caps upside? For our covered call bear, that's the deal breaker. That's the nagging fear of missing a huge run-up that keeps them on the sidelines. So how do you even begin to solve a puzzle like that? Well, there's a newer ETF out there that's trying to crack this very code. So let's pull back the curtain on something called QDVO. Think of QVDO as a kind of hybrid. It doesn't want to be just a growth fund, and it doesn't want to be just an income fund. It's actively managed, which is key, and it's trying to deliver a blend of both worlds by holding big growth stocks and pairing them with a flexible, tactical income strategy. And the first thing that probably jumps out at you is this number, a trailing yield of 8.71%. Okay, that's definitely going to get your attention. But remember, a big yield is only half the story. The really interesting part is how it's trying to generate that income while still keeping its foot on the growth pedal. So this is the growth engine right here. We're talking about the biggest names in the game. NVIDIA, Apple, Microsoft, familiar faces. But you've got to notice the concentration. The top 10 holdings make up almost 2/3 of the entire fund. So this isn't a broad market bet. It's a very targeted, very focused play on the giants of large cap growth. All right, here are the quick vitals. The ticker is QDVO. It's pretty new, launched in late 2024. It is actively managed, which comes with a 0.55% expense ratio, and its mission statement is crystal clear: go for capital appreciation and deliver monthly income. Okay, so now we get to the secret sauce. What exactly makes this thing different from those rigid, old-school strategies that our covered call bear is so worried about? The fund thinks about making money in 3 separate streams. First, you've got the good old-fashioned price return, hopefully from those big growth stocks going up. Second, any regular dividends those stocks happen to pay out. And third, the extra juice, the income generated from selling those call options. The key is that it's not just relying on one thing. And this chart right here, this is the whole ballgame. A rigid mechanical fund might just slap options on 100% of its stocks, month in and month out, no questions asked. But QVVO's approach is tactical. The managers get to decide when to sell calls, on which specific stocks, and just how much of the portfolio to cover. Their goal isn't just to crank out income at all costs. It's to try and strike that delicate balance with growth. So what does that look like in the real world? Okay, let's say the market is just ripping higher. In theory, this tactical approach means QDVO should capture a lot more of that upside than a fund that's fully covered. But, and this is super important to remember, it'll probably still lag a pure growth fund because it's still trading away some of that potential upside for income. Now, what about a flat, boring, sideways market where stocks are just treading water? Well, this is where a strategy like this is really designed to shine. When you're not getting much from capital gains, that extra income from the option premiums can become a huge driver of your total return, giving you a real edge. And of course, the big one, what happens when things go south? In a downturn, that steady stream of income from both dividends and options acts like a cushion. Now look, it's not going to magically prevent losses, but it can act as a shock absorber, potentially softening the blow and reducing the overall drop compared to a strategy that's all in on growth. Look, no strategy is a silver bullet, right? It just doesn't exist. So let's be really clear and lay out a balanced view here, the good and the not so good. So the potential advantages, they read almost like a wish list for our covered call bear. You get a better chance to participate in rallies, you get the flexibility for managers to adapt to whatever the market throws at them, and you get that steady income stream when the market just goes nowhere.
But you absolutely have to look at the other side of the coin. First, that concentration risk is real. You're making a big bet on just a handful of companies. Second, this fund is the new kid on the block. There's just no long-term track record to look back on. Third, you're relying on the managers to make the right calls at the right time. And finally, remember, the capped upside is only reduced. It is not gone completely.
I think this quote just nails it. It sums up the entire bargain you're making. You're basically agreeing to accept a little bit of a drag on your performance during the really hot markets. And what do you get in exchange for that? You get income and a buffer when the market is flat or falling. That's the deal. So keeping that core trade-off in mind, let's try to figure out where a strategy like this could even fit into a portfolio and who it's really built for in the first place. You know, the best way to think about this is probably on a spectrum. On one far end, you've got your pure growth ETFs, maximum upside potential, very little income. On the other end, you have those rigid covered call funds, high income, but very limited upside. QDVO is trying to live right in the middle of that spectrum, aiming for a healthy blend of both. So who might actually take a look at something like this? Well, our covered call bears, for sure. But also, really, any investor who's looking for that mix of growth and income. Anyone who's maybe a little worried about uncertain or choppy markets ahead. And frankly, anyone who believes that having an active manager making tactical decisions can actually add value.
And that really just leaves us with one final big question to chew on. In a world that feels increasingly volatile and uncertain, is a rigid, rules-based approach the safest way to go? Or is flexibility the ultimate asset? That's the core bet behind a strategy like this one, and it's something worth thinking about for any investor. Thanks for joining.